to the next point.
Towards
We should ensure
us.
whatever we say is clear.
That means work is being done. We can see that it is in opposite direction.
Good day, learners, listeners, and viewers at home. I am Blessing Ayuba Samson. I am here today to take you on our third topic, on our subtopic of principal book, that is the ledger. And our topic is the rule of double entry. Before I take this lesson, I will take a preview of what we did in the last lesson, which is the subsidiary book, where I said the subsidiary book is the first entry. That is the first book of accounting, the first entry where transaction is taken before it can be posted into the ledger. And I listed reasons why we should have a subsidiary book: to know the total sales and total purchases in a business organization, and to be able to track debtors and creditors that are owing the organization. I also gave some divisions of subsidiary books, where we have the sales day book, the purchases day book, we have the return inward, the return outward, the general journal, the cash book, and the petty cash book. Today we are going to talk about the principal book, which is the ledger. The ledger is the final destination of all transactions in the subsidiary book. It is also the most important book of accounts. The ledger is used for double entry. It's a book for double entry keeping. It is a very, very important book in accounting. And my students, know it in your mind when we say a book is principal, that means it's the ultimate. We have divisions of the ledger. The ledger can be classified into A, personal ledgers. Number one, ledgers can be classified into personal ledgers. These are ledgers for creditors and debtors. For example, we have the purchase and the sales ledger, where organizations or business enterprise collects goods or purchase goods on credit, and also a proprietor or an organization buys goods on credit. That is what we mean by purchases and sales ledger, which is the creditors and the debtors. It is classified under the personal ledger. Then B, we have the general ledgers. These are ledgers for real and nominal accounts. General ledgers are ledgers for real and nominal accounts. For example, we have expenses accounts. In an organization, we have to undergo expenses where we pay rents, we pay salaries and wages, we pay for water, lighting, so it's under expenses accounts. Income accounts is a general ledger. We post, that is where the organization has income comes into the organization. We have sales accounts, purchases accounts, and also the assets accounts. All of these are under the general ledger, where I say the general ledger comprises of the real and nominal accounts. Number C, we have the private ledgers. These are ledgers for capital and drawings of the proprietor. The private ledger are ledgers for capital and drawing account of the proprietor. Who is a proprietor? A proprietor is the owner of a business, can be the director of a business. So the ledger that is attached to them is private, where salaries are there, where they draw money, where they keep their capital. And this ledger, private ledger, is not for all You don't have access to that ledger easily. It's supposed to be confidential. It's a confidential ledger. That's why we say it is a private ledger. Then we say purchases, number D, purchases or creditors ledger. Wherever you see purchases, another name for a purchases ledger is a creditors ledger. This ledger contains personal accounts of suppliers stroke creditors. Purchases or creditors accounts ledger is for the personal accounts of suppliers where goods are supplied on credit. It is always stated in the purchases or creditors ledger. Who is a creditor? A creditor is somebody that we buy on credit from, where a proprietor buys on credit. They supply to the proprietor on credit. And the account is open, that is a creditor's ledger, where all the supplies are made on credit are posted to. Then number E, we have the sales or the debtors ledger. The sales or the debtors ledger. This ledger contains personal accounts of debtors and customers. As a business organization, you should open an account for your personal customers, and where customers collect goods on credit or buy on credit, they are debtors. It is also stated in the sales or debtors ledger. Then we have the nominal ledger. This ledger contains accounts of losses, expenses, gains, and income. A nominal ledger is a ledger that contains losses. In business, sometimes we have losses, and it is always in the nominal ledger. Expenses, when they are made, it is in the nominal ledger. When incomes are gained, it's also posted to the nominal ledger. Then we have the definition of an account. What is an account? As a financial accounting student, you are supposed to know the definition of an account. Even as a businessman or woman, you should know the definition of an account. An account can be defined as a record in a double entry system that is kept for each class of assets, liability, revenue, and expenses. An account is a double entry system where we have a portion that is kept for assets. What are assets? These are what the business owns that they use to make money for the business. Liabilities is what outsiders own the business. Then we have revenue, what comes into the business to increase the business. And expenses is what we spend in the business. So accounting is all about assets, liabilities, income, expenses, and all, and so on. Now, accounts can be classified into two. Accounts can be classified into two. We have one, personal accounts and impersonal accounts. I'll take that again. Accounts can be classified into two, the personal accounts and the impersonal accounts. Let's take the definition of personal accounts. Personal accounts, these are accounts for names of individuals, firms, and business enterprises. Personal accounts are accounts for names of individuals that we do business with, and firms that you engage business with, and also business enterprise is personal account. For example, Shegun account is a personal account. Ibrahim Limited is a personal account. Then we have the debtors and the creditors. They are all individuals that we deal with. So they are under the personal accounts. Then we have the impersonal accounts. These are accounts for properties. When we say impersonal, they are accounts for properties. items of expenditures, and income. Impersonal accounts are accounts for properties and items of expenditures and also income. They can be divided into real accounts and nominal accounts. Impersonal accounts are divided into two: real accounts and nominal accounts. Real accounts are accounts that we can see, we can touch, and we can move. They are accounts for assets. My students, when you start any business organization, every asset that you bring into that business is what you turn around to make profit or loss for that business. So it is under the real accounts. Examples of some of these assets are land and building, furniture and fittings, machineries. You can see a land, you can touch a land, and you can also stay on the land. Building and machineries, they are all assets and they are all under the real accounts. Then number two type of impersonal account is the nominal accounts. These are accounts for expenses incurred. Nominal accounts are accounts for expenses incurred, income received, losses and gains. They cannot be seen. They cannot be touched or moved. But we do transactions with them and we state them down. So they are all under the nominal accounts. For example, rent accounts. A building, if you are hiring a building for business, you have to pay rent. Discount received from suppliers and discount allowed, the ones that you are allowed as a proprietor of a business. We also have lightning accounts. We also have wages and salaries. They are all under the nominal accounts. Then we have the rules for debiting and crediting. In double entry, this is one of the rules for debiting and crediting is the account which receive is the debited one. Rules for debiting and crediting is that the account which receive is debited with the value that comes into the account. Let me expatiate on this. In business, whenever income comes into the business, whenever sales are made, that is a value is coming into the business, is going to be debited. And when we say debited in an account, in a ledger, we have a T-square account. On your left side is the debit side of the account. On the right side is the credit side of the account. Now, if an income is coming into your business, you debit, which is on the left side of the account. Then number two, the account which gives is the credited one. You credit with whatever value is coming into that account, and it's always on the right-hand side. Now you can see this, credit is a giver, debit is a receiver. Credit is a giver. When you are paying rent, you are going to credit. When you are paying salaries and wages, you are going to credit. When you are receiving sales or loan, when money is coming into your business, when you are making sales, you are debiting the account. Now let's take number one examples of double entry system. January 1st, BC started business with 10,000 cash. Before I take the example, my students, two things are involved. When you want to open a ledger or a double entry account, you have to put two things in mind. The name of the account. One, what am I debiting and what am I crediting? If you know these two, then you are good to go. Names of the account, what is to be debited and what is to be credited. Now, January 1st, BC started business with 10,000 naira cash. What is the effect on this account? BC, 10,000 cash. And the first income that we start any business with is called the capital. So we have two accounts here. That is why we say the double entry system. The effect will be on the capital account and on the cash account. When you are starting business, the first thing that comes to your mind is that you are introducing cash, and that cash is called capital. So two accounts are to be opened, the capital account and the cash account. Now, what account is to be debited and what account is to be credited? You are going to debit cash account with 10,000 naira, and you are going to credit capital account with the same 10,000 naira. Now let's look at the table. This is the ledger entry. I said it's a T account. We have the debit side and we also have the credit side. And in our question, we said we are going to credit the capital account. I know you'll be thinking that in the cycle, in the table, capital is going to come. It is the heading that will be the capital account. And you will debit the cash, you will credit the cash with 10,000 naira. Then we said in the effects that we are going to debit our cash account with 10,000 naira. You can see the debit side and also the credit side of your account. And the heading is cash account, which is debited with capital 10,000. This capital on the credit side of the account is the money for your business, and it has increased. It started with 10,000, so it is a credit. Even when money is coming into your account, what does the transaction state? Credit alert. Credit alert. So you start your business by crediting your account, by crediting your capital account with a cash of 10,000 naira. Let's take the second example. January 2nd, the proprietor, who is a director, the chief executive of a business. Another name for a proprietor in accounting is the owner of the business. Put a further 5,000 into the business by check. The proprietor put a further 5,000 naira into the business using check. So what account will come to your mind? Check is involved, so there must be bank. Effect is going to be on your capital account and also on the bank account. So what is a transaction? What are you debiting and what are you crediting? We are going to debit our bank account with 5,000 naira and credit our capital account with what? 5,000 naira. Our ledger entry is going to be like this. You have your T account, your debit side and your credit side. And we are going to credit our capital account. Our capital account, January 2nd, bank, we are crediting bank with 5,000 naira. Then we are going to debit our bank account. January 2nd, capital, 5,000 naira. This is for this. Then the third one, the third example. On January 3rd, bought motor van, 60 naira, paying by check. Two accounts are involved, motor van and bank accounts, because there's check. So when there is check, the transaction is between the proprietor and the bank. And the effect is going to be like debit motor van with 60 naira, credit bank account with 60 naira. So this is our ledger entry. On our debit side, and we are going to debit a motor van account, and our motor van is going to be the heading. We are debiting it by the bank, 6 naira. Then the bank account is credited with motor van, which is January 3rd, motor van, 60 naira. And our fourth transaction January 4th, he took 500 cash as drawings. The proprietor took 500 naira cash as drawings. Where does he draw his money from? The bank. So there are two transactions here, the drawings and the bank account. And our account is going to be like this: debit the drawings with 500 naira and credit bank account with 500 naira. This is our ledger entry. Your debit side on the left-hand side, your credit side on the right-hand side. Your heading is your drawings account. January 4, bank, 500 naira. The second transaction, debit, bank account, then you credit your bank account with drawings, 500 naira. Now, let me take a summary of what we have done today. We talked about the ledger, which is the most important book of account, and we say it's the principal book of account, where after all transactions are posted to, and it's always in the double entry form of account. In the ledger, we practice our double entry account. Ledgers are classified into 6, where we have the personal ledger for debtors and creditors. We have the general ledger that contains the real accounts and the nominal accounts. And I told you what is a real account. Real accounts are accounts that you can see, you can touch, and you can move. These are accounts for assets. Examples of assets are buildings, machineries, furniture, and fittings. Where the nominal accounts are accounts for expenses, losses, gains, and income. We also talked about the purchases or the creditors account, ledger. Anytime we see purchases ledger, it's the same name with the creditors ledger, where the accounts contain the accounts of the suppliers and the creditors. Then we have the sales or debtors accounts. The account contains the personal accounts of our customers and also the debtors. The nominal account is for losses and expenses incurred in the course of doing business. Then we define the word account. Account is a double entry system that keeps assets, liabilities, revenue, and expenses. In business, we have assets. We must have liabilities. And income must come, and expenses must be incurred. So that is what account is all about. And I gave you 2 types of account. We have 2 types of account. I wouldn't say type. Accounts are classified into 2, personal accounts and impersonal accounts. Where personal accounts are accounts for names of individuals, organizations, and enterprises. We gave an example of Shegun accounts. Ibrahim Limited is an enterprise. Then we have the impersonal account, where is an account for properties. There are accounts for expenditures, and there are accounts for also income. And impersonal accounts are divided into 2, where we have the real accounts and the nominal accounts. We gave rules of double entry. The rule of double entry, one of the main rules of double entry is that every credit entry must have a corresponding debit entry. And every debit entry must have a corresponding credit entry. Credit is the giver, while debit is the receiver. And the credit is always on the right-hand side of your account, while the debit is always on the left-hand side of your account. My students, I have come to the end of today's class. Before I leave, I'm giving you this assignment as a take-home. Number 1, A, what is ledger? State its characteristics. Number 1B, differentiate between a ledger and an account. Differentiate between a ledger and an account. Number 1C, what is debit balance? What is credit balance? I will take number 1 again. Number 1A, what is ledger? What is ledger? State its characteristics. 1B, differentiate between a ledger and an account. 1B, differentiate between a ledger and an account. Number 1C, what is debit balance? What is a debit balance? Number 1C again, what is a credit balance? Number 2 of my assignment, complete the following table using the account to be debited and credited. Complete the following table using the account to be debited and credited. 1. Goods sold for cash. 2. Cash sales. 3. Paid rent by cash. Number 2. Complete the following table using the account to be debited and credited. 1. Goods sold for cash. Cash sales. Paid rent by cash. When you are done, you can please send your assignment to my WhatsApp number or a text message to 081-8269-2515. I'll call my number again, 081-8269-2515. I remain Blessing Ayuba. Thank you for listening.